Islamic finance principles. Have you ever wondered what actually makes Islamic finance different from conventional finance? Is it simply about avoiding interest? The answer is no. Islamic finance is based on a broader set of principles designed to promote fairness, transparency, responsible investment, and a connection between financial transactions and real economic activity. In this video, we will explain the 7 fundamental principles of Islamic finance in simple terms. Let's get started. First Islamic finance principle: no riba, or no interest. The first and most well-known principle is the prohibition of riba, commonly translated as interest or usury. In Islamic finance, simple lending money and requiring a predetermined increase in return for the passage of time is not considered permissible. Instead, a financial return should generally be connected to something legitimate, such as trade, leasing, investment, or ownership of an asset. This does not mean that Islam prohibits making a profit. Profit from legitimate business activity is allowed. The key difference is how that profit is generated. For example, instead of simply lending money and charging interest, an Islamic financing structure may involve the purchase and sale of an asset or a lease agreement. Second Islamic finance principle: avoid gharar, or excessive uncertainty. The second principle is gharar. Gharar refers to an excessive uncertainty, ambiguity, or lack of clarity in a financial contract. Islamic finance requires contracts to be clear. The parties should know what is being purchased, the price, the responsibilities of each party, and the important terms of the agreement. This principle is designed to reduce disputes, deception, and unfairness. It is important to understand that Islamic finance does not mean that every form of risk or uncertainty is forbidden. Business naturally involves risk. The concern is excessive or avoidable uncertainty in the essential terms of a transaction. The third Islamic finance principle is no Maysir, or no gambling. The third principle is Maysir, commonly associated with gambling and games of chance. Islamic finance discourages transactions where gaining wealth is primarily dependent on chance or gambling, rather than legitimate economic activity. The idea is that wealth should generally be generated through productive activity, trade, investment, or services, not simply through betting on an uncertain outcome. This is one reason gambling-related businesses and financial arrangements are generally excluded from Sharia-compliant investing. The fourth Islamic finance principle is invest in halal activities. Another important principle is that money should not be invested in activities that Islam considers prohibited. Depending on the Sharia standard being applied, this can include industries such as gambling, alcohol, pork-related businesses, and certain other prohibited activities. So Islamic investing is not only about looking at financial numbers. The underlying business itself matters. A company can potentially be financially successful, but if its core business is prohibited under the relevant Sharia standards, it may not qualify as Sharia-compliant investment. The fifth Islamic finance principle is risk should be connected to reward. One of the most important ideas in Islamic finance is risk sharing. In simple terms, if you want to earn a legitimate return from an investment or asset, you generally need to be exposed to relevant ownership or business risk. Islamic finance therefore places significant emphasis on sharing risk and rewards rather than creating a guaranteed return simply because money was lent. Two well-known examples are Mudarabah, where one party provides capital and another provides management or expertise, with profits shared according to an agreed arrangement, and Musharaka, a partnership where the parties contribute capital and participate in the business. The exact rules depend on the contract and Sharia standard being applied. The sixth Islamic finance principle is finance should be connected to real assets or economic activity. Another major principle is the connection between finance and the real economy. Islamic finance generally emphasizes transactions involving real assets, services, trade, or productive economic activity. For example, Mudarabah is structured as a sale transaction in which an asset is purchased and then sold to the customer at a disclosed markup, often with deferred payment. Ijaraha involves leasing. Other contracts include salam and istisna, which are used for specific types of transactions involving future delivery or manufacturing. The important idea is that financial transactions should have a legitimate economic substance rather than being purely speculative. The seventh Islamic finance principle is fairness, transparency, and ethics. Islamic finance emphasizes fair dealing and ethical conduct. Contracts should be honored. Important information should not be deliberately hidden. Parties should understand what they are agreeing to. Financial activity should not be designed to exploit or unfairly harm another party. The principle of fairness is one of the reasons Islamic finance looks beyond simply asking, how much money can this investment make? It also asks, how is this money being made? And is the transaction fair and permissible? Now, let's put all these 7 principles together. Islamic finance is not simply conventional finance minus interest. It's a broader framework. It generally seeks to avoid riba or interest, avoid excessive gharar or uncertainty and ambiguity, avoid maysir or gambling and chance-based wealth generation, avoid prohibited industries, connect financing with real economic activity, encourage appropriate risk sharing, and promote fairness, transparency, and responsible financial behavior. These principles are reflected in different Islamic financial contracts and products, with detailed requirements depending on the specific Sharia standard and scholarly interpretation. So now take this important question. What does all of this mean for Muslims living in the United States? It means that when you are considering a mortgage, car financing, business financing, investment, or another financial product, you should not look only at the label. A product being called Islamic, Halal, or Sharia-compliant does not automatically tell you everything about its structure. You should look at the actual contract, how the transaction works, what assets or services is involved, what risk each party assumes, and which Sharia standards or scholars are overseeing the product. For important financial decisions, it's also wise to consult a qualified financial professional and a knowledgeable Sharia scholar who can evaluate your specific situation. Core principles of Islamic finance teaches us no riba, no gharar, no maysir, no prohibited industries, real economic activity only, risk and reward, and above all, fairness, transparency, and ethical financial conduct. Understanding these principles give you a much better foundation for understanding Islamic mortgages, halal car financing, Islamic investments, business financing, and Islamic banking. Dear friends, if you found this video helpful, make sure to like the video, subscribe to the channel, and share it with someone who wants to understand Islamic finance. See you in the next video, inshallah. Till then, Assalamu alaikum wa rahmatullahi wa barakatuh.